with that. Okay, here is our quick review about analyzing and recording transactions. So we know that the Financial Accounting Standards Board creates GAAP, and those are the rules, the generally accepted accounting principles that we have to follow in financial accounting, right? And internationally, there are other standards, international financial reporting standards, but most American companies follow GAAP. We know that the Securities and Exchange Commission enforces GAAP, right? The SEC. All right, we talked about some of the principles and concepts. I'm not going to go through each of these, but hopefully you can sort of think back and remember what we learned about. These are fundamental to accounting, to GAAP. We know the accounting equation. We understand that transactions are recorded first to the journal and then to the ledger, right? We'll see those steps in the accounting cycle. We've learned about debits and credits. Which column is the left column? Debit. Debit is the left, credit is the right. There's a terrible rap video that another accounting professor shared with me. It's terrible. It gets stuck in your head. And last semester I showed it to my class and I told myself I'm never going to do that again. It will always remind you that debits are on the left and credits are on the right, but then you'll always remember that song and it's going to annoy you. So I'm not going to show you that. But debits are on the left, credits are on the right. One way, if you're having trouble thinking about that, maybe think about the fact that there's an R in credit and it's on the right. R for right. Okay, so that might help. Okay, we looked at how different types of accounts increase on the debit side and different ones increase on the credit side, right? What was the acronym I taught you to help you remember which ones increase on the debit side? Deal, which stands for what? Dividends, expenses, assets and losses, right? Dividends, expenses, assets and losses, right? So everything else, when it increases, you record it on the credit side. Then if you're thinking about something that has decreased, like maybe you paid out some cash, so it decreased, then you have to do the opposite, right? Okay, we went through that. I also taught you that if something increases on the debit side, then it normally has a debit balance. If it increases on the credit side, it normally has a credit balance, right? We talked about how equity has two parts: contributed capital that came from the investors in exchange for stock, and the retained earnings, which are made up of the profits of the company that it has retained, right? And the profits come from the revenues, the sales, minus the expenses, and also minus any dividends that have been paid out to the investors. That's what makes up retained earnings. We looked at these different asset types of accounts. We looked at different liability accounts. Remember, payables and unearned are always liabilities. So even though it says unearned revenue, because it says unearned, it's a liability. And remember also, whenever you see prepaid, that's always an asset. Okay. What else did we cover? Oh yeah, this showed us how revenues minus expenses gives us the income statement. The net income or net loss from the income statement becomes part of the statement of stockholders' equity and also part of the statement of retained earnings as well, which becomes part of the balance sheet, right? Because the balance sheet includes the equity. We saw how those fit together and how you need to create the income statement before you can make the statement of stockholders' equity and the retained earnings statement, and then you can make the balance sheet. Right, what else? The accounting cycle. So this chapter, we're focusing on the first four. analyzing and identifying transactions, right? You have to start there. What was this transaction? And then you can post it to the journal because you can then figure out which account to credit and which account to debit. And then you can copy that information over to the ledger. And why do we need to do that? What's different about the ledger compared to the journal?
The journal's chronological.
Journal is chronological. Every transaction goes in there. A ledger is different how?
It's just account.
Yes, each account is separate, right? So you can look at an individual account and see all the transactions in that account. Correct. Then we can take the balance of every account from the ledger and put them into what's called a trial balance. It's just a listing of all the accounts and their balances. And then since some accounts will have a debit balance and some will have a credit balance, we can make sure the total debits equals total credits. This is what a journal entry looks like. These are T accounts and they represent what the ledger is basically like, although the ledger, basically the T account is a simplified version of an account in a ledger, okay? So we really only use T accounts in teaching accounting. You don't use them in actually doing accounting. The ledger looks a little different. This is the trial balance that we talked about. And again, you have the assets first, followed by liabilities, and then your different equity accounts. We then talked about original source documents. What is an original source document?
Bill?
A bill would be an example. It would be when you get a document with information that has to be entered into the accounting records, right? That is an original source document. All right, then we look through a whole bunch of examples. I'm not gonna make you go through all of that again. More examples. Let's see. A few more. Oops. Oh, that's not it. Okay, that was as far as we got, so we are going to start right here. Is there anything you would like me to clarify? Any questions? No, everybody's all right? Okay, so we'll start right here. I am recording. I hope. Yeah. Okay. So let's see what's going on in this transaction. It says we paid in full with cash for equipment that was previously purchased. What do we call it when we make a purchase, but we don't pay at that time? Accounts payable. Correct, because we have to pay for it later, right? So now in this case, we are paying for that account payable and we are paying cash. So let's think about that. Excuse me. I'm sorry. Let's think about why are we debiting accounts payable? Because it's decreasing. Correct. Accounts payable is what type of account?
Liability.
The liability. And so it's not part of deal, right? And so that means it increases on the credit side, and when it decreases, we debit, which is the left, right? Now, how about cash? Cash is what type of account? An asset. An asset would increase on the debit side, but here it's being credited, right? The account that's being credited is indented, and then you see the number under credit. So why are we crediting cash?
Because it's decreasing.
It's decreasing, right? Because we paid it out to our supplier. So we have an asset credit going down, and we have a liability accounts payable going down. Are we in balance? Yes. Okay. And I broke it again. Let's see. Here we go. Okay, then we paid $3,600 in salaries expense to employees. Right? We see salaries expense being debited, cash being credited. Well, as we just saw in the last example, if we're paying out cash, it's going down. So that means that asset will get credited and we see an asset going down. Why does it say here that equity is going down?
Expenses lower equity.
What's that?
Expenses lower.
Expenses lower equity, correct. So since salary expense, which is part of deal, right? Since we have an expense, it's going up and we have to debit it. But when an expense goes up, equity goes down. Even though an expense is an equity type of account, the impact it has is it reduces equity. Okay, that can be a little confusing, but hopefully you get it. Any clarification needed there? Same thing with dividends, right? When dividends go up, they get debited because they are part of deal, but they reduce equity. Okay, very good. We received a cash payment from a customer. Okay, cash goes up, so it gets a debit. Accounts receivable, which is also an asset, goes down, right? Why did accounts receivable go down?
Because they paid.
Because the customer paid, right? So we've already received the money, so it's no longer receivable. And that is also an asset. So here we see cash going up, accounts receivable going down. The net impact is 0. The nice thing about accounting is it's logical. I mean, once you understand how it's set up, everything works. Logical. It's all math. It's just getting the hang of it that takes a while. Okay, we provide $1,200 in services to a customer who wants to be billed. Okay, so that means we now have an account receivable, right? So we're debiting that asset. What does the service revenue represent? Yeah, we made a sale. Exactly. And is revenue part of deal? No. So when it increases, we credit. And the impact the revenue has on equity is it increases our equity, right? So we see asset going up from the account receivable, equity going up from the sale. Okay. You all are doing very well. Purchases, supplies on account. Okay, we bought some supplies on account. So supplies go up, that's an asset. Accounts payables, what type of account? Liability. So our liabilities go up. Are liabilities part of deal?
Wait.
What is deal? Dividends, expenses, assets, and losses, right? So liabilities are not part of deal. So they increase on the credit side, and that's what we see here. Our debt is going up, so we credit. And our liability we see has gone up. Okay. So if we took all of those transactions that we've gone through today, and we actually started them on Monday, and just put them in the journal, you see how all of those transactions are in one long list. We see, for example, cash in some cases is going down, in other cases, cash is going up. So if we needed to know what is the balance of a particular account, looking at the journal is not going to be super helpful because every single transaction's in there, right? It's way too hard to try to pull information out of there. And that's why if we copy this over to the ledger, we can look at an individual account and quickly see all the transactions related to that particular account. Oh, we're up to exercise 15. Great. We haven't done that yet, right? So let's go ahead and do exercise 15. So go ahead and open up your exercise sets. Ken. Okay, here we see the relationship between the journal and the ledger. As I told you, we record things first to the journal, that's step 2, and then to the ledger, that's step 3. So here we see this journal transaction where the company got cash and issued common stock, and then those debits and credits have to get copied over. The $20,000 debit to cash gets recorded under the cash account in the ledger. And you see that we're just debiting $20,000 just like we did here. Now, this is not super clear because there would normally be lots of transactions in each account. But that's basically what an account looks like in the ledger. You see each account, well, has a name, has an account number. You see the date, description. There's a reference field in case you need to put some reference information. You've got a debit column and a credit column, and then you've got the balance that shows you what is the current balance in that account. So we can surmise here that since we debited $20,000 and there's a $20,000 balance, that is the only transaction that has occurred in that account. This must be a new company. Then same thing with common stock. We can see a credit to common stock in the journal. That becomes a credit to common stock in the ledger. It's that simple. Okay. All right. Here, let's see. Oh, these were all the transactions that involved cash. So from all those transactions we looked through, these are the ones that involved cash. Again, in some cases, we see cash getting debited because it's going up, and in some cases credited because it's going down. You could figure out what is the balance in the cash account this way, but it's really, even if you pick out just these entries, it's not that convenient. Much easier if you look in the ledger, right? And you look in the cash account because all you will see is cash transactions. You see every time cash went up in the debit column, every time cash went down in the credit column. You can see which transactions those were from and their dates. So this makes it easy to keep a running balance of how much is in the cash account. The company started off with a $20,000 investment. Then it got some money from a client, $4,000. So the balance went up to $24,000. Then the company paid for a utility bill, $300. So then the balance goes down by $300. So you can keep a running balance and always know how much cash is in that account, right? So how much cash is in the account at the end of this period? 24,800, correct. And we can see that here. Now, if you were to add up all the debits and subtract the credits, you would get 24,800. If you're going to go line by line and say 20,000 plus 4,000 minus 300 minus 100, you do it that way, you get the same number. So either way, you can figure out your balance, okay? So it's just a different way of doing math. Cash normally has a debit balance, right? It increases on the debit side and normally has a debit balance. If we spent this entire $24,800, what would our balance be in the cash account? Zero. Could it go less than zero? Could we ever have a credit balance? Not really. Like, how would that even happen? Now, your bank account can have a negative balance, but that's a different thing. Right? That's the bank telling you you owe them some money. But in accounting, you're always going to have a debit balance in your cash account. Or zero. Okay? And if you have a zero in your cash account as a company, then you've got other problems, right? That means you're broke. All right, we can see the relationships where those transactions from the journal got carried over. The green ones just are the ones where cash is going up, and the red ones are the cases where cash was going down. So just every transaction is getting recorded to the ledger from the journal. Okay, let's look at, again, the impact of the journal on the ledger. We're going to use these T accounts here to represent the ledger. So here we've got this original transaction, $20,000 received by the company, cash goes up 20,000, the company issues common stock, which is a credit, common stock gets a credit of 20,000, right? Okay, here's another transaction, the company got some equipment. Did the company pay for the equipment? No, that's why they have an account payable, right? Equipment is an asset, so it increases on the debit side. Accounts payable is a liability, so it increases on the credit side, right? Now here we have another cash transaction of $4,000 getting paid by a customer. So remember, we already got $20,000 from an investor. Now we got $4,000 from a customer, so we can see the balance in our cash account is $24,000, right? Here's another transaction. Same thing, right? You're just going to copy whatever is in the journal, debit to accounts receivable, credit to service revenue, to the individual accounts in the ledger. Where it gets interesting is here. So here, here's a transaction where cash is going out because we paid for a utility bill, right? So now if we look in the cash account, we see those two transactions where cash had come in, but now there's a $300 credit to cash. So we have to subtract that to get our balance, right? You take the two debits, 20,000 plus 4,000, subtract the credit, 300, that's how we get our balance. So remember, in accounting, if you've got an account with mostly debits, anytime there's a credit, you have to subtract it. If there's an account with mostly credits, whenever there's a debit, you're going to subtract from the credits, right? That's how we find our balance. Okay, here's another transaction with cash going down. So you see cash has dropped by another $100 there. Here we've got cash going up. So again, that goes on the debit side. Now we add that, right? This one, another cash going down. And here we have, oh yeah, in fact, what happened here? If we look in the accounts payable account, on January 5th, there was a credit. On January 18th, there was a debit, and they're both the same amount. What does that tell us? What happened with accounts payable? Okay, we had a $3,500 debit from before, and now this one is goofed up a little bit. Here it is, accounts payable goes to here. So now we have a debit to accounts payable, which means it's going down because we paid it down. So what is our balance now in accounts payable? Zero, exactly. Perfect. All right, what else? Another cash transaction. I think you get the idea, so we don't have to look at each one. Here's accounts receivable. Looking at this, January 10th and January 23rd, what happened with accounts receivable?
They get money.
They paid us the money? That's right. On January 10th, accounts receivable went up, meaning customer owed us money. On January 23rd, it went down by the same amount. That means they've paid it in full. And we now have a zero balance under accounts receivable. How about revenue? What does revenue represent? Income from sales, right? Typically sales. Service revenue means we sold some services. And we can see that that's happened 3 separate times. Now, revenue is one of those accounts that's typically only going to be credited it wouldn't be very common that you would see a debit. So it's generally just going to keep going up until the end of the period when you're closing out your books, and then you wipe it down to zero. So, okay, if we take all of those transactions and we were to map them out like this, so here are all of the cash transactions from the ledger, all of the accounts receivable, supplies, equipment. So these are all asset accounts, and we can see their balances. Do they have debit balances or do they have credit balances? All the assets have debit balances. Then we can look at our liability accounts, accounts payable and unearned revenue. Do they have debit or credit balances?
Credit.
They both have credit balances, right? And that makes sense because liabilities increase on the credit side and they normally have a credit balance. Then we get to equity. That's where it gets a little more complicated, right? Because common stock will have a credit balance. Dividends that reduce equity have a debit balance. Revenue has a credit balance, but expenses that again decrease equity, they have a debit balance. Okay. So it all fits together. If we were to add up all of the assets, would they equal the total of the liabilities and the equity? Yeah, they have to under the accounting equation. If we were to add all of the debits that accounts have, would they equal all of the credits that other accounts have? If you took the assets, which all have debit balances, you added them to the dividends and the expenses that have debit balances, the total of those debits would equal the credit balances of all the other accounts. So our accounting equation will always be in balance, and our debits and credits will always be in balance. How Luca Pacioli, I think was his name, how he figured this out 400 years ago, I don't know, but it works. Huh? Can you say something? Okay, another exercise. So let's stop recording and do number 24. Okay. So it says we've got the following transactions. We see them here by date. And we need to prepare the journal entries for these 4 transactions. We need to be able to explain why we debited and credited each account and find the new balance in each account. So let's think about these one at a time. April 25th, we stopped by our uncle's gas station to refill gas cans for our company. And the uncle adds the total to our account. Okay. How would we journalize that transaction? What accounts do you think would be involved?
Expense.
Okay, there is an expense, right? What kind of expense? An expense for gas. Okay, so we could debit our gas expense account. Now, I told you that things like supplies, they're an asset until you use them and then they become an expense. But with gas, it's different because how do you track exactly how much gas you use, right? That would be kind of difficult. So as soon as you purchase the gas, it's already considered an expense. But most assets, or at least most current assets, it's only once you've used them that you count them as an expense. Okay, so we're going to debit gas expense. And what else would we do?
Credit cash.
We would credit, but not cash. Because what did we do? It says that the uncle added the total to our account, right? So we haven't paid for it.
Oh,
So we would credit
accounts
Oh.
receivable. I'm sorry, accounts payable.
payable. You got it. You got it. Okay, good. Let's go on to the next one. So we have a week's worth of revenue for lawns that we mowed. We earned $1,200 and we got paid 75% of that. So that would be $900 we received in cash. So we did $1,200 worth of work, got paid $900. What accounts would we debit and credit?
You debit service fee?
Service revenue would be credited,
Oh,
right?
yeah.
As revenue increases on the credit side. What would we debit? Accounts receivable for how much?
Three.
The remaining $300. And what about the $900 cash? That also has to be debited, right? So we would have two debits, $900 for cash, $300 for accounts receivable, and that would equal our $1,200 service revenue credit. Okay, I'll show you all of these on the next slide, but I just want to work through them mentally here first. April 27th, we pay the newspaper $35 to run an advertisement. What will we debit? What will we credit?
Credit $35.
Yeah, but for what account?
Account bill.
Okay, so we are gonna have a $35 account payable credit. Yes, and what will we debit?
An expense account?
An expense account. Remember, the answer is all often in the question with these types of questions. So if we look in here, hey, told us we were paying cash, right? So that was Jacob's tip that we are crediting cash. And yes, there is an expense. What is that expense for?
Advertising.
Advertising. So it's an advertising expense. Okay. So again, there was a clue there, advertising. And then we make a $25 payment on account, doesn't say what account, but some account where we owe money. So what is that transaction going to look like?
Payable, credited,
So close.
not debited.
So accounts payable, we are making a payment, right? So our account payable is going down because it's a liability. That means we debit. But what are we going to credit in this transaction? Cash. Anytime you see the word pay, payment, cash is going out. So you're crediting cash, okay? So let's look at these transactions. There was the gas expense and accounts payable. There was remember we got paid part of the work we had done. So we have both cash and an account receivable in exchange for the revenue that we did. Then we had the advertising expense that we paid for in cash, and the account payable we paid for in cash. Okay. So again, the harder part is not the numbers. When it comes to journal entries, it's figuring out what account is it that we're having to debit and credit. Are there any questions? All right then. Okay, let's look at the balances of these accounts. Do they seem to have a normal balance? What should be the normal balance in cash? Debit or credit? Debit? That's right. Okay, if we look at these debits and we compare it to these credits, does this account have a debit balance or a credit balance?
Credit.
Would you say, Julian?
I think it's debit. I didn't add it.
Just feels like debit, looking at the numbers. If you add it up, you'll find that the debits are larger than the credits. And we know that cash normally has a debit balance, so that makes sense. So if you either add up all the debits and subtract the credits, or if you just go down line by line, you will find you end up with a debit balance, and that is the normal balance in the cash account. What about accounts receivable? What would be the normal balance? Also debit, right? Because it's also an asset. And what do you think? Do we have a debit balance or credit balance based on these numbers?
And the balance?
Yeah, the debits outweigh the credits. So we would end up with a debit balance, which is normal for that account. And here we have accounts payable. What should be the normal balance? Debit or credit? Credit. Who said that? Yeah, exactly. Because it's not part of deal, right? It's a liability. Then it should have a credit balance. And we do see the credits outweigh the debits here. So it would have a credit balance. Okay. Great. The trial balance. We've talked about it before, but this shows you how you would take the balance of every account in the ledger. We've got the cash account, accounts receivable, supplies, etc. You take the balance from every account and just list it in the ledger. I think we have a close-up. Yeah, here's a close-up. Which type of account do we start with in the trial balance? Assets. First, the current assets, and then any long-term assets. What comes next? The liabilities, right? Accounts payable and unearned revenue. Then we get to our different equity types of account, with expenses being at the end. And notice that some accounts have debit balances, right? Some have credit balances. Notice that they equal down at the bottom. So the trial balance is a way to check and make sure our debits equal our credits. And again, if they don't, we know there's a mistake somewhere, so we can go track it down. Do you remember how many trial balances there are in the accounting cycle?
3?
There are 3. Okay, bonus question. What are those 3 trial balances?
Unadjusted, adjusted and closing.
Nice. You have the unadjusted trial balance. That is step 4 of the cycle. Then step 6 is the adjusted trial balance, because it's after you've made some adjustments. And then step 9, I think it is the post-closing trial balance. After you've closed out the revenue and expense accounts and the dividend accounts, you do a final check, and that is called your post-closing trial balance. Perfect. I didn't expect anyone to know that, so good job. All right. Any questions? All right, so this we see is the unadjusted trial balance, and again, that's the 4th step of the accounting cycle, and it's the first of the trial balances. All right, complete the trial balance for Magnificent Landscape Service. Okay, well, it's already been done here, but let's just take a look. So we see there were 2 cash transactions. Cash ended up with a $4,000 balance. And over here in the trial balance, there's a $4,000 debit for cash, right? Accounts receivable, we can see here. Accounts payable, that has a credit balance. So we see that over on the right. Common stock has a credit balance. Service revenue has a credit balance. And then our expense accounts have debit. So what is our total debits? 4,500, correct? What is the total of the credits? Same thing, 4,500. Okay, so that's all you have to do to make a trial balance. It's kind of refreshing when you get an exercise or problem that just tells you to make a trial balance. With one exception, there are a couple of tricky ones that we'll do in next week when we talk about adjusting entries. But just because the publisher made them difficult, but normally they're pretty easy. Okay, another exercise. Let's do this one. We should be pretty close to the end of the chapter here. Anybody who watches this video in the future is going to wonder why I keep flipping the slides. Okay, so this is what we've learned. The FASB created GAAP, continues to modify it over time, right? GAAP, what does that stand for?
Generally accepted.
Generally accepted accounting principles. What role does the SEC or Securities and Exchange Commission have in relation to GAAP?
They monitor corporations.
Yeah, they enforce GAAP. They make sure that companies are following GAAP. I might have told you that the big Enron scandal back around 2001, 2002, they were not following GAAP. They came up with their own rules that were not GAAP compliant. And when it went to court, the judge said, sorry, you weren't following GAAP. So that was illegal. We talked about the conceptual framework, all the different concepts and other things that I can't remember what they're called, principles and assumptions that have to do with accounting. We looked at how we can expand that accounting equation. Assets equals liabilities, but the equity has two parts. What were the two parts of equity?
Contributed capital.
Contributed capital and retained earnings, right? Contributed capital comes from what?
That's
The investors, right? The retained earnings is impacted by what?
dividend.
Dividends, and then net income or net loss. Okay. Let's see, we know that there are all these different accounts. Companies get to create as many accounts as they need. They get to decide the names of the accounts, but we'll see like the standard names like cash and sales revenue and things like that. And each account has a number that's up to the company as well. There are some standards in numbering your accounts, but if you go from one company to the next, you'll notice their numbering is a little different. Let's see. Oh, yeah, as it says here, when you're numbering the accounts, you start with the balance sheet accounts and then go on to the income statement accounts. Same thing on the trial balance, right? Trial balance starts with the balance sheet accounts, assets and liabilities. Then you get down to equity, including at the end, the revenue and expenses, the income statement accounts. So the order of the trial balance roughly matches the order of the numbering of the accounts. We learned the different steps in the accounting cycle. We focused on the first 4 steps to identify and analyze each transaction. And I think I've mentioned to you that for a lot of companies today, this is an automatic process. But if you were doing it manually, you'd have to look at what that transaction was, so you would know how to record it to the journal. And then you would copy that information to the ledger, and then you could make your unadjusted trial balance. Right? And I think that's it. Chapter 3. Okay. Is there anything you all have questions on or would like clarified?